How's it going, YouTube? Limelight Capital here, back for another video. So yeah, guys, I did take a just a break and a little vacation. Just from social media, everything pretty much. But back on the grind, guys. I do think that we will start to see some action. The summer is always a quiet time for the financial space. Haven't seen much action in the market. Especially with our favorite stock. So yeah, guys, let's just get into this one. Just gonna keep it short and sweet. Again, please leave a like on the video. Subscribe to the channel if you're not already. Leave your thoughts on this in the comments below, just to get us in the algorithm and try to get this information out to other people. We definitely want as many people as possible learning about this situation and shedding some light on it. So yeah, that would be greatly appreciated. Just a reminder, this channel is not monetized. Just for anyone that was curious, I'm doing this mostly to help out the community. But yeah, let's jump in. So this is another post by Criand. Also, I'm sorry, I am not a financial advisor. It's a post by Criand from last week. Last week, it was a post that had caught my eye. I did read this already, but I'm glad to go through it again and read it aloud, just to digest it a little more. Criand can use some very colorful language, and they're a very smart person, whoever they are. So, going through it for a second time is no problem at all. So that the title of this is "Out the Money Puts are the past puck of short positions that is slowly being passed back. The price movements are around monthly options, SLD periods, and net capital requirements, not FTDs." Preface: I'm not a financial advisor. Da 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 da. So he does say, speaking of which, this whole post is rather speculative. It does need more discussion. I marked it as DD. Da 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 da. I don't believe FTDs or failures to deliver, I'm going to call them FTDs just for time's sake, have ever driven the price movements, and therefore T21 and T35 cannot be the solution to the puzzle. I'm leaning towards net capital around monthly options and SLD phases instead. The out the money puts that expired, and also another thing, OTM is out the money, but I'm going to just call them OTM just for the sake of time. The OTM puts that expired on July 16th and other dates are not hidden FTDs. I believe that these are covered puts that the short hedge funds, SHFs, have sold to pass the puck of their short position as a balance sheet trick. Therefore, you should not expect the price to shoot up from these puts. However, the expirations are significant. In theory, shift their margin call price down. And yep, I've written about both of these in the past, T21 and at the money puts. Guess what? I can be wrong, and I have been in the past. The T21 cycle or T35 theory seemed good until it let out a tiny fart on June 24th. That's when it was time to take a step back and look at everything again. Does this change the thesis that shorts haven't covered? Hell no. I'm just saying we probably still don't know what's driving the price movement. I'm tossing a curveball at you, or rather a curve wrench. So part 1, FTDs are not driving price movements. Reg Show has done nothing. As a recap of Reg Show, it was implemented by the SEC to try to curb short selling and naked short selling by establishing a few rules regarding failures to deliver or FTDs. These rules force closeout of FTDs on a time frame, barring various conditions. The notable sections are 242.204 and 242.203, where some theories of GameStop price movements originated from. Basically, these rules require FTDs to be closed out after n number of days after being identified as FTD. For the T35 theory, it requires buys to close out the FTDs. So there's a highlighted image here. It says, resulting from a sale of security that a person has deemed to own on the 35th consecutive calendar day, the trade date for the transaction immediately closes out the failed to deliver position by purchasing securities of like kind or quantity. And that's from 242.204. Seems reasonable. We could track an FTD spike and then count out T plus N days, and buy-in should occur to drive the price movements. However, the text there is important. It states on the 35th consecutive calendar day following the trade date for the transaction, immediately close out the failed to deliver position. This means that for 242 or any Reg Show rule to apply, the FTDs would have to be carried the full 35 days in order to be subject to this rule. Reg Show isn't going to apply to FTDs which are no longer reported to the SEC because they have been satisfied or closed out. Popping up a chart from October 20th to January 2021, and there's a chart here. It's basically showing failure to delivers that for GameStop reported by the SEC. I'm not going to go too much into it. I will link this post below if you guys want to read it. Way on the left side, there's a spike of FTDs reaching 3 million aggregate around October 12th, so that's this big pink spike here. By October 13th, FTDs dropped to around a million. And by October 15th, FTDs dropped to a meager 40,000, so that's down here. Reg show T plus 35 does not apply here to those 3 million FTDs because they were already satisfied or closed out by the 15th. If buy-ins were used to satisfy the FTDs, then we should have seen a price increase when the FTDs were satisfied, but that did not happen. The price stayed stagnant. The same continued on through the rest of 2020 and into January 2021 until FTDs permanently dropped to an average of under 100,000. FTDs are closed out, satisfied. Price doesn't increase due to buys, and those FTDs are gone. They're not subject to the T35 rule because they are not carried in the full time to be obligated by those closeout rules. Following January, they allegedly moved to shorting ETFs containing Gamestop. Here's a chart from Broca, username Broca on Reddit, charting FTDs of Gamestop and ETFs from January 2021 to May 2021. So this is the chart from Broca here, and it does show a massive, massive spike here in January, which is this huge blue candle here, and that's from the IWM ETF. There are red arrows pointing to drops in FTDs throughout the year, which are those. Despite there being significant fails on certain dates, they were closed out almost immediately and were no longer subject to reg show requirements, just like from October 2020 to January 2021. Again, notice how no significant price movements occurred when those FTDs were closed out. The key takeaway here being that if reg show was actually driving the price movements, then we would be seeing FTDs accumulate and be carried the full T plus N days for buy-ins to be forced. Rather, they are satisfied, closed out rather quickly without any significant increase of the stock price. On top of this, I do not see how only a couple million FTDs could suddenly cause a surge of 20 to 30 million volume per day for that price surge from May 25th to January 8th. Likewise, back for the January or February spikes with tens of millions and hundreds of millions of volume. The number of FTDs does not go up. With all that being said, I can't see T21, T35, T plus N reg show playing a role here at all, mainly because of loopholes and bypassing closeout requirements. Part 2, loopholes, buy rights, dodge reg show forever. If you can dodge reg show, you can technically don't have to meet your FTD closeout obligations, and you can continue on happily shorting a stock. Here's a little blog post about possible dodging of reg show closeout requirements. It outlines quite a few possibilities despite reg show being foolproof. Note that these are alleged and have not necessarily been performed ever, but it is worth bringing up because there's still cracks that can be used to circumvent the rules. And there's a whole list here. There's only two highlighted ones which I will read. If you want to look at the rest, I will link it down below. Permitting important hedge fund clients to bypass the locate requirement when entering short sales, transacting illegal stock sales, and dark pools off the primary markets to avoid New York Stock Exchange oversight and to maintain anonymity. Sound familiar? One thing that is not listed above are buy right trades as defined by the SEC itself, which there is pretty good evidence of and therefore much more believable than the above bullets. I've listed about buy rights in another post, where I did some quick math to show that the shorts most likely never covered when the short interest dropped from 226% to 30%. Instead, they utilized a malicious options practice called a buy right trade. This trade is with a complicit market maker to make it appear that the short hedge funds had met their FTD closeout obligations while still maintaining their position. The buy right is a quick transaction. 1. The short hedge fund sells deep in the money calls to a market maker or other counterparty. They choose deep in the money calls due to the almost guaranteed trade between the two parties. It is unlikely that others would be using these deep in the money calls. The market maker sells shares to the short hedge fund. They can sell these shares without first locating them in a bona fide agreement, so despite liquidity, the trade can be performed. 3. The short hedge fund now has enough shares to spoof the clearinghouse that they met their FTD closeout obligations because they have the shares. The FTDs are reported drop off a cliff. 4. The market maker wants to remain neutral in this trade. They exercise the deep in the money call to get the shares that they sold to the short hedge fund back to them, and the trade is closed out. What happened here is that the short hedge fund never lost their original position, and the market maker remained neutral in the trade without generating additional shorts. So in the entire buy right transaction, a deep in the money call is used to swap these shares. These typically happen on the same day, and call open interest does not increase because the options are closed out right away. Let's check for evidence of these buy rights in October and January. So there is a list here, which it's very small. I really can't see it, but I guess it shows, proof of a crap ton of buy right trades done by the short hedge funds back in October to January. In the above picture, big spikes of in-the-money call volumes occur around FTD dates, and there is no subsequent increase of in-the-money call open interest despite the large volume. Glance at the volume for January 22nd, 2021, and the corresponding change in OI. That's a lot of volume for little to no OI change. Poof, the FTDs are gone, and the SEC gives Reg Show a handshake for a job well done. These alleged buy rights continued to happen throughout 2021 per Brokaw's data on suspicious deep in the money call volumes. The die-off in the money calls comes coupled with the lack of FTDs on Gamestop itself because shorting was most likely moved to ETFs. Another chart here from Brokaw that shows suspicious deep in the money call volumes and FTDs in the year 2021. If they haven't been performing these buy right trades and potentially other FTD dodging methods for a long time, I doubt that they'd suddenly stop now and allow Reg Show to take over. They'd continue to kick the can by any means. FTDs for GameStop have been a meager amount for a long time, and they are never carried the full T plus N days. If they can dodge closeout requirements with any method whatsoever, then why not continue doing it over and over and over? If I just can't see Reg Show or T2135 playing a role, I can, however, see the price movements being about monthly options and net capital because it's a balance sheet issue. Part 3, monthly options, SLD phases, net capital, and share offerings. Thank you to Jaboni, username Jaboni, thanks Dad, and many other users who identified the share offerings could have been detrimental to the price movement and suppressed things. T21, the game of hide and seek, is finally over, and while I'm at it, I might as well try to prove how July 14th is going to become our new January 13th. Which makes sense. The two share offerings that occurred were April 5th to April 26th, 3.5 million shares, and June 9th to June 22nd, 5 million shares. This means that not only were 8.5 million shares sold into the market, resulting in more sell pressure, there was also that many more shares available to legally borrow. These allowed a large suppression of the price because that was about a 15% extra float added from the original 57 million float. Per the above sections of this post, I think FTDs and Reg Show do jack all in my eyes. It would be balance sheet related, such as net capital 240.15C31. I've written a post about net capital in the past, thinking it tied together the T21 theory, but again, I'm tossing out T21 T35 completely. A quick summary of net capital requirements for brokers and dealers. Net capital is designed to ensure that a broker-dealer holds at all times more than $1 of highly liquid assets for each dollar of liabilities. Example, money owed to customers and counterparties, excluding liabilities that are subordinated to all other creditors by contractual agreement. The premise underlying the net capital rule is that if a broker-dealer fails, it should be in a position to meet all unsubordinated obligations to customers and counterparties and generate resources sufficient to wind down its operations in an orderly manner without the need of a formal proceeding. A broker-dealer must ensure that its net capital exceeds its required minimum net capital at all times. In other words, you must have enough capital to not be margin called. If they do not maintain enough capital, there are risks to their customers and counterparties. This rule tries to ensure that they have enough money to pay up in the event of a default. The juicy part is that short securities on their books are calculated with an ever-increasing haircut against their net capital requirements. So the longer those short positions are held, the more it eats away at their net capital and puts them at risk. So there's a little image here. It says deducting the market value of all short security differences unresolved after discovery and ordinance with the following schedule. So number of differences, and then it has 25 to 100%, and then number of business days after discovery. So basically all it's saying is, the amount you have to pay for the short position increases over time. We also have supplementary liquidity deposit SLD phases around monthly options, which requires a chunk of liquidity to be deposited to the NSCC 2 days prior to monthly options expirations and is held by the NSCC until T plus 9 days following expiration. This is a perfect opportunity for the SLD requirement to eat up enough liquidity for net capital to become an issue. Their short positions cannot let them default, so they need to wipe out the positions with buy-ins. It's off to the races in some SLD periods as the price goes on a spiral upward, driving more buy-ins. But if a share offering is placed around these monthly options, then it can kill off the momentum due to the dilution of shares and giving a larger amount of fresh shares to borrow. Here's everything plotted out since January. So there's a chart here about the SLD periods, and it pretty much shows that in between, each SLD period, the price usually gaps up. But recently, with the last two share offerings being in, April to May and then June to July, it didn't go up, obviously. So January, no share offering, price goes on a run. February, no share offering, price goes on a run. March, price goes on a run, share offering kicks in and kills the momentum. April, price cannot start on a run because of the share offering, extra shares available to legally borrow short. May, no share offering, price goes on a run. June, cannot go on a run because of the share offering, extra shares. And then July, no share offering, price might go on a run. So at the money puts are not hidden FTDs. This is part 4, I'm sorry. At the money puts are not hidden FTDs, but they could be a past puck of the short positions. On to my other speculative part of this post. Oh, Magic 8 Ball, tell us what the at the money puts mean, because I sure as hell don't know, but I have a theory. There are a few posts that these at the money puts are hiding FTDs that there will be by I butchered that, I'm sorry. There are a few posts thinking that these at the money puts are hiding FTDs and that there will be buy pressure because of expiration. I do not think that is the case. Rather, the expirations of these at the money puts are more detrimental to the short hedge funds due to it being a past puck coming back to them. The main theory is that they're utilized as married puts to hide FTDs and dodge reg show closeout obligations. I have 3 problems with this. 1. The married put method, as outlined by the SEC, would typically use at the money or in the money put options. What we've been seeing are deep out of the money puts, such as 50 cents deep, literally the lowest possible things could go. They could just have a market maker saying, well, screw it, let's do a married put, but that feels like too much of a leap. The buy right trades are already being used to dodge reg show closeouts, and we see evidence of them utilizing the deep in the money calls to perform that trade. The numbers of the buy rates and out of the money puts line up scarily close from the January drop from 226 to 30% SI, short interest. That was 1.1 million calls and 1.1 million puts. Why would they double dip? One of the methods is enough to accomplish this goal. There have been significant out the money put expirations over time with no buy pressure following the expirations. January 29th, 327,000. February 5th, 263,000. February 12th, 248,000, March 19th, 447,000, and April 16th, 427,000. So what's going on? Again, this is speculative, but I believe that they utilize the covered put approach. This is easy enough for the short hedge fund to do because they already met their requirements in order to sell them. It's like selling a covered call. You'll need 100 shares to be able to sell the covered call to someone. In order to sell a covered put, you need 100 shorts. In this trade, it would be the short hedge fund selling and presumably Citadel buying. A covered put is the options trading strategy which involves shorting the underlying asset along with selling a put option on the same number of shares. By doing this, the trader is able to generate income in the form of a premium for writing the put option. The short hedge funds already have their shorts. They've already amassed their FTD shorts to the clearinghouse through buy right trades. Why open up the out of the money puts? Why sell them? The short hedge fund can get a tiny amount of cash as premium when they sell the out of the money put. Very, very minuscule amount, but even enough to give them slight buffer in their cost basis of the short position. The short hedge fund can pass the puck of their short position over to the buyer of the put until expiration. On the short hedge fund's balance sheet, they can erase the short position and say that they are now short the put rather than being short the stock, and thus their shorts will no longer be in danger of them being margin called. Note arbitrary numbers being used as an example here. In other words, for number 2, think the following. You have 30 million shorts on Gamestop. Your short position is eating up 30 million times $150 or $4.5 billion, and you're close to being margin called. What do? You'll sell covered puts to your buddy who wants to help you not get margin called. The puck will be passed to them until expiration, and the price will hopefully go down really low by then. You can't scrub all the shorts, but a good majority. So you sell 20 million divided by 100 or 200,000 out the money puts to them. The puck is passed until expiration. You now effectively have 30 million minus 20 million, so you have 10 million shorts on your balance sheet. Your short position is only eating up 10 million times 150, which is 1.5 billion instead of the 4.5 billion, and you're safe from being margin called for the time being. The margin call price has essentially been shifted up 3x despite the price still trading at 150. The math isn't that simple, but that would be the gist of it. Maybe you spread these puts out to various expiration dates. Over time, these puts expire. It slowly passes the puck back to you. These puts are gone, but your short positions are transferred back to you. It's a game that can't be played forever. Better hammer the price down before time runs out. One date rolls by and it expires 50,000 of these puts. That's 5 million shorts back for a total of 15 million of the original 30 million. The short position is now eating up 15 million shorts worth off of the balance sheet rather than only 10 million shorts. The margin call price starts to shift back down. Soon enough, all of these puts expire and all the shorts are back on your balance sheet. You better hope that the price has deteriorated enough to avoid being margin called by the time that happens. What have we seen over time? At the money put open interest skyrocketed in January and has been deteriorating over time. If the theory is correct, then their margin call price was shifted up a significant amount in January when put open interest peaked and has been decaying since then. Notice the massive drop following April 16th expirations. Surprise? It's no ordinary option expiration. That's when Citadel and banks were starting to work the night shift. The July 16th operations should drop the majority of these puts once more, sending back roughly 400,000 open interest or 40 million shorts worth back to their balance sheets, with the remaining 200,000 open interest on January 2022. Once again, surprise, surprise, lots of FUDs started popping up around the significant expiration date. By the looks of it, this is what's currently going on, assuming 1.1 total out-the-money puts, 110 million shorts, 190% short interest of float stuffed away in January. So he does have a chart here, and it just shows number of shorts still hidden. It's basically just, data of what we just talked about. I'm going to skip that for now. The short hedge funds are about to get a huge puck of shorts passed back to them, which can shift the margin call price down a lot, which could be why there is so much desperation lately to hammer the price and it's still FUD. Interesting timing around this massive option expiration date, in my opinion. If you recall, Melvin got their cash injection on January 25th. The price of Gamestop that day went from an open of 96 to a high of 159 to a close of 76. The out-the-money puts and buy rates started to occur on this date. Maybe the margin call price was actually hit in January but was dodged because of this practice by passing the puck for a brief period of time. Maybe the margin call price is about to come back close to those scary levels. Maybe I'm off track here as well. And he does have a meme at the end. It just says, "Oh, I don't think I'm a lot dumber than you. I don't think I'm a lot dumber than you thought. I'd think that I thought I once was." It's from Dodgeball. But yeah, guys, very interesting post. Criand always has pretty, amazing takes on what's going on. I know this post is pretty technical, so I'm going to try to, make my next video and next couple videos, a little more beginner friendly. I know this is hard to understand, but, if I'm going to add my 2 cents to it, basically what is going on here is, he had theories. I'm not sure if it's a guy or a girl, but they had theories, and other people in the community on Reddit did as well, that FTDs, and there was like an FTD cycle, which was the T21, T35, basically thinking that there was a cycle of when we could basically predict price run-ups. And they basically have tossed it out the window just because the date in June, the last date, there was no price action, so they kind of had to throw it out the window. But again, could have been because of share offering, who knows. But, I personally believe we're going to see some price action soon. Even if you just look at the, I'm just going to pull up the GameStop chart real quick here. Even if you just look at the chart, let's see here. So we did have a little bit of a red day, not a big deal. But if you look at the, say the 30-minute chart here. Actually, no, let's look at the hourly. So if you look at the hourly chart here, actually let's go to the daily here. So if you look at the daily, we had this run up here. This was January to February. Took about a month off, month and a half, and then March, April had a run up, and then we had a share offering here, so no run up. So you got to look at it like month or two time frames. Had a little bit of a run up here, even with the share offering, and now we've just been going flat. So just based on history of the stock through this year, we would probably see some sort of a let's see here, some sort of let's draw a line here. So some sort of, we're probably going to have to follow a trend line. Let me see. Probably something like this, I'd say. If we're going to do a trend line, probably something from here. I'd say we'll probably follow something up. I mean, that would just make sense, you know what I mean? But again, guys, it's really, TA on the stock, I'm sure as everyone knows, is kind of a fool's game. No one can really predict anything. I do think Criand has a lot of good takes. They're a very smart person. But yeah, I mean, I'm thinking that we're going to see some sort of a nice trend coming up in, probably the next, couple of weeks, maybe a month or so. I would like to see, a really nice trajectory here, because we have seen these nice vertical run-ups, pretty much, but it's based on that theory that we just read, was the share offerings could have affected it. So yeah, guys, I am going to be, I just realized the graph that I just did at the end wasn't actually showing on the screen, so I do apologize for that. Yeah, guys, but again, please leave any support you can on the video. It's much appreciated. And yeah, guys, I'll catch you in the next one. Enjoy the rest of